Investments sometimes need a little spark to ignite a revolution, and in the world of finance, one man set the stage for a major turmoil. Meet Michael Milken, a former financier and investment banker who left an indelible mark on the high-yield bond market, better known as junk bonds. His story is about ambition, influence, and ultimately deception. But don't worry, we're not here to bore you with complicated financial jargon. Instead, we'll take you on a captivating journey into the life of Michael Milken, the man who reshaped the financial landscape. So buckle up and get ready to delve into the captivating world of high-stakes finance as we uncover the intriguing tale of Michael Milken, the mastermind behind the rise of junk bonds. Michael Milken's thirst for knowledge led him to pursue a stellar education. He attended the University of California at Berkeley for his undergraduate studies and then ventured to the prestigious Wharton School of Business for his MBA. But it wasn't just the diplomas that shaped his path. His fascination with corporate bonds truly ignited his passion. But wait, we want to welcome you to Capitalista. Make sure to give a smash on the like and subscribe buttons down below. Going back, armed with his newfound knowledge, Milken embarked on a groundbreaking endeavor at Drexel, one of the leading investment banks of the time. He saw the untapped potential in the world of junk bonds, those risky yet potentially lucrative investments. With relentless determination, Milken convinced Drexel's top brass to let him establish a junk bond trading operation. It was a bold move as most institutional investors were wary of such high-risk ventures, but Milken was undeterred. Armed with research by Walter Hickman, a former president of the Cleveland Federal Reserve, he crafted persuasive sales pitches that promised investors higher returns if they embraced the world of junk bonds. His charisma and conviction knew no bounds as he traversed Wall Street, engaging with hedge fund managers and mutual fund managers, urging them to abandon their traditional conservatism. And guess what? His salesmanship worked wonders. Milken's ability to present the risk-return trade-off of junk bonds as an unbeatable investment strategy led many investors to jump on board. They were enticed by the allure of higher yields and the notion that the potential gains from non-defaulting bonds would more than compensate for the losses incurred from defaults. Now let's talk about junk bonds and how Michael Milken revolutionized their issuance. Milken had a knack for spotting potential where others saw only risk. He saw an opportunity to help struggling companies and private equity firms access much-needed capital by issuing junk bonds. These bonds were not your typical safe and secure investments. They were issued by companies with less than stellar credit ratings, making them riskier in the eyes of many investors. The skepticism surrounding junk bonds was understandable, as the default probability was higher than investment-grade bonds. But Milken had a different perspective. He believed that the higher yields offered by junk bonds more than compensated for the increased risk. He saw potential in these companies that others overlooked and knew that they could thrive and generate substantial returns for investors with the right financing. To make his case, Milken used his persuasive skills to convince struggling private equity firms that junk bonds were their ticket to growth and success. He offered them access to much-needed capital that traditional banks refused to provide due to the perceived risk. This created a win-win situation as these companies could expand their operations while investors could potentially earn higher yields. However, as the demand for junk bonds increased, Milken faced challenges in selling them to investors who remained skeptical. To overcome this hurdle, he resorted to less legitimate means. One notable tactic was bribery. He offered personal deals like exclusive opportunities to purchase warrants or options to influential individuals such as portfolio managers. These personal deals served as incentives to convince them to invest in his junk bonds. Additionally, Milken was not averse to manipulating stock prices to further his agenda. He would collaborate with individuals like Ivan Boesky, a prominent hedge fund manager, to provide insider information and artificially inflate stock prices. This manipulation created a perception of success around the companies issuing the junk bonds, enticing more investors to jump on board. The Securities and Exchange Commission grew suspicious of Milken's activities and launched an aggressive investigation. The SEC had their eyes on the duo, suspecting insider trading and market manipulation. Under pressure, Milken's underlings at Drexel were coerced into testifying against him, revealing the extent of his illegal activities. The evidence against Milken became overwhelming, leading to his eventual downfall. In the face of mounting legal pressure, Milken negotiated a plea deal. He pleaded guilty to several charges including securities fraud and aiding false reporting, but denied the more serious allegations of bribery and insider trading. The plea deal allowed Milken to secure a shorter prison sentence and a substantial fine. Despite his conviction, Milken has maintained his innocence regarding the more severe accusations. Nevertheless, the evidence against him, including his involvement in bribery and insider trading, suggests a darker side to his financial empire. Now, the expansion of the junk bond market has its drawbacks. Defaults became a significant concern as many companies issuing these bonds had questionable economic viability. This in turn contributed to the savings and loan crisis, costing taxpayers billions of dollars in bailout funds. Drexel, the powerhouse behind the junk bond market, faced its share of consequences. The Securities and Exchange Commission charged the investment bank with numerous civil violations, exposing its failure to monitor its employees' activities. These violations ultimately led to Drexel's bankruptcy and the end of its era. Michael Milken faced a hefty fine as part of his legal repercussions. He was ordered to pay a record-breaking sum, significantly impacting his wealth. Additionally, his conviction barred him from working in the securities industry, ending his reign in finance. Despite his conviction, Milken turned his attention to philanthropy. He became involved in prostate cancer research, contributing significantly to the cause. His efforts in this field aimed to make a positive impact on society. However, what is concerning is the continued idolization of Milken in the financial industry. He hosts the annual Milken Conference, where hundreds of powerful financiers, businessmen, and politicians gather. This continued adulation sets a dangerous role model for future generations, promoting a mindset prioritizing personal gain over ethical conduct. Michael Milken's story is one about a former financier who achieved immense success through fraud and deception. It is a stark reminder of the need for ethical behavior in the financial industry. Unchecked greed can lead to devastating consequences, as seen in the expansion of the junk bond market and the subsequent defaults and financial crisis. What's more, the continued idolization of Milken raises questions about the values upheld in the financial world. So, what are your thoughts on the importance of ethics in finance and the impact of unchecked greed? Share your thoughts in the comment section down below. That's it for this video. Don't forget to express your gratitude by clicking on the thumbs up button, following Capitalista, and enabling notifications to stay updated and won't miss any of our future posts. See you next time and stay safe.